Good afternoon and welcome to the Victory Virtual event 2021 Year in Review and 2022 Outlook. Today we're going to spend some time reviewing our thoughts on 2021 as well as giving our outlook in 2022 in both the equity and fixed income markets. My name is Derek Cattell and I'm in charge of sales for the direct investor business. As a reminder, as we round the corner into 2022, don't forget to visit our tax center at vcm.com to get the latest timelines for tax forms, frequently asked questions, etc. Victory Capital is a publicly traded company on the NASDAQ exchange. Our ticker is VCTR. Our wealth advisor group combined has over 270 years of investment experience and includes several certified financial planners and certified investment management analysts. Your dedicated wealth advisor is here to assist you with your investment needs, and it's done as a courtesy for our valued clients. Joining me today is Kelly Cliff. Kelly is president of the investment franchises here at Victory Capital and will be speaking about the equity markets. Also joining us today is Jim Jackson. Jim is head of fixed income and will be focusing on the bond markets today. Kelly, can you start us off, please?
Yes, thank you, Derek, and welcome everyone to the Victory Virtual 2021 Market Review and 2022 Outlook. For those of you that Victory is new to you, we are what is called an integrated multi-boutique asset manager. So we have various investment teams, and you're seeing them on this slide with all of their various brands. And these are specialized teams that have niche strategies that they offer within the capital markets. And across all of these investment franchises, we have strategies that are across US equity, growth value, large to small, international, global, emerging markets, fixed income, and alternatives. The two newest franchises that Victory has added to our investment platform are New Energy Capital. This is a pioneer in the space of investing in clean energy projects and companies. And West End was added at the end of last year, which is a provider of SMA ETF strategies. So I'm president of investment franchises at Victory, as Derek has mentioned, and I get the opportunity to work with all of these franchises and get a lot of valuable insights as to what we're seeing in the markets. So why don't we take a look at the markets and how they performed in 2021. As you can see, 2021 was another strong year in general for the equity markets, as you can see by these bar charts. And it's quite remarkable how resilient the market was if you think about some of the events that occurred within 2021. We started off the year with the invasion of the Capitol building, which delayed the presidential certification, also led to some violence. The markets seemed to be unaffected by that and continued in a smooth fashion. We also saw cryptocurrency in January hit a market value of 1.6 trillion. Arguably, much of that interest is from people's concerns about monetary policy, inflation, and so a rise to that level seems to be quite startling, and the equity markets seem to still take that in stride. There was also a global semiconductor shortage. This was a result of COVID, a COVID market where demand for PCs and electronics was really outsized as people were at home and ordering these things online and really pushing up demand for those types of products. And it was really meaningful. And even GM came out and had an estimate that they think about 1.5 billion of earnings for the year that they would be affected by this global semiconductor shortage. So quite startling. We also, if you remember, had a blockage in the Suez Canal. You may be wondering, why that would affect global capital markets, but this was a pretty significant 6-day shutdown of this canal. This canal controls 12% of global trade and also 30% of shipping container volume. So that was quite a disruption. And once again, the equity markets seemed to be able to ride through that quite well. We had many other very amazing events. We had Hurricane Ida, we had the delay of the US debt ceiling, we had a China property crisis, and the equity market still posted a quite solid year. Usually conventional wisdom would say equity returns above 8 or 9% in any year are considered a very strong year. And as you see this chart, many of the bars for the year surpassed that. And it was also quite different in 2020 in one regard. And if you look at the two top indices as represented by S&P, the S&P 500 index and the S&P 500 equal weighted index, you can see that the results for those two were quite similar. Now, this was different from 2020 in the sense that many of the largest companies in the indices, and what I mean by the largest companies is Apple and Facebook and Google. These types of stocks really dominated performance last year in the large cap market cap weighted indices, and this year we actually had much more well dispersed performance within large companies as represented by the equal weighted indices. We did see large cap US stocks once again lead small cap stocks and non-US equity stocks. So that is still a phenomenon that continued in 2021. But having said that, the Russell 2000 as a representation for US small companies still had a pretty solid year-to-date return of just about 15%. Non-US equity across the globe, as represented by MSCI EAFE, which stands for Europe, Asia, and Far East, is a representation of non-US developed markets. It had a positive return and north of 10% for the year. And the MSCI Emerging Markets Index, which is a representation of emerging markets as opposed to non-US developed markets. There was the one exception and posted slightly negative returns for the year, and that was largely driven to some of the very focused problems in China, the China property crisis, an elevated rhetoric of regulation from the Chinese regulators, and that seemed to dampen some enthusiasm for those stocks. But what's quite interesting is if you go to the MSCI Emerging Markets Small Cap Index, the small cap companies, more indigenous companies, less susceptible to global trade, they actually did quite well, and we rarely see such a performance difference between the large cap segment of the emerging markets versus a small cap. And then finally, at the bottom of the graph, you see the US dollar index spot rate, which is a broad measure of how strong the US dollar is against major currencies. And you can see it actually had a very strong rise throughout the year. So if you look at the non-US equity indices that I mentioned above, that mitigated some of the benefit that those investors received. And so local investors in those markets actually received much stronger returns as their returns did not need to be translated to US dollars. So that is a quick snapshot of many of the important segments of the global equity markets. Now I'd like to slice it up a little bit different and look at the US equity markets by style. And I think this is important because for quite a few years now, growth has really outpaced value-oriented stocks in a meaningful way. And 2021 was a little bit different in the sense that we finally found a period where investors started to favor more value-oriented stocks. So just think of value-oriented stocks as being cheaper on average than the market as a whole, and growth stocks being more expensive from like a PE perspective as the market as a whole. So these lines, as I already mentioned in the previous slide, the equity markets have been going up. So this is just comparing the difference between value-oriented stocks versus growth-oriented stocks throughout the year. So when any one of these lines is going up, the value-oriented stocks are outpacing their counterpart. So for instance, the top line, the dark blue line, that is the Russell 2000 value universe of stocks, subtracting the performance of the Russell 2000 growth stocks. So you can see there was a large run up in the early part of the year of the value oriented stocks within this small cap space, outperforming their growth oriented stocks. And it pretty much continued in a little bit of a volatile way throughout the year and finished the quarter on an upward trajectory. We also see that for the mid cap stocks, which is represented by that middle line. So this has been much different than what we've seen in the past few years. As I mentioned earlier, growth has been quite the in-favored investment approach. The one exception is on this graph is the Russell 1000 value minus the Russell 1000 growth stocks, so large US cap stocks. They had the similar run up as mid cap and small cap US stocks in the beginning of the year, but it seemed to peter out in the middle of the year, and then actually ended the quarter of the fourth quarter of the year and actually slightly trailed. So growth actually outperformed value there. I think that segment is a little bit different as some of the largest names that are in the Russell 1000 Growth Index that I mentioned earlier, Apple, Amazon, Google, Facebook, names like that, had some pretty strong earnings reports there at the end of the year. And a bubbling up of Omicron probably aided people's sentiment towards stocks like that can presumably operate more efficiently in a environment where the consumer is more reluctant to go out given the spread of the Omicron variant. So let's take a look at the non-US equity style performance. So once again, MSCI represents non-US equity stocks in developed and emerging markets areas, and broke this up in the same way as the previous slide, where we're showing value versus growth. So when these lines go up in that particular segment, value is actually outperforming growth. So we saw, so the top green line is the MSCI emerging markets value minus the MSCI emerging markets growth stocks. And as you can see, a similar pattern as in the US. So sort of a global phenomenon of value regaining investor favoritism, and outperformed pretty meaningfully by the end of the year, 10%. And then the other lines that you look at, they had a very similar increase at a very similar time early in the year as you saw on the previous slide, but then seemed to peter out at the end. And those were for the developed markets and the emerging market small cap and the developed small cap markets. I think the COVID lockdowns outside of the US were more frequent, more impactful, and didn't have much of an impact as it did in the US, where investors were still a little bit more favoring companies that they feel operate a little bit better in a COVID environment, that are technology-laden companies, that are not, you know, travel and areas where the consumer needs to be physically present to purchase goods from the company. I think, as I mentioned earlier, the China regulation, and that affects some of the largest companies, or concerns with the largest companies in China, which are largely technology oriented companies. This largely helped the emerging markets value stocks over growth stocks. So let's take a look at valuations. And I mentioned that growth has been outperforming really globally value-oriented stocks in many segments. And one way to look at valuations, and there's many ways, but one way to look at it is a price to trailing 1-year earnings. So how much are you paying for the last year of earnings per share for a company? And this is a very conservative measure, because you're not looking at forecasts, you're looking at actually what transpired versus the current price. And so we've calculated here the PE multiple as of the year end of 2020 and the year end 2021. So if we just take one number here, we look at the US large cap for 2020, the growth column, the multiple is 40.3. And I can tell you that that was pretty rich. Growth stocks started the year at a very rich multiple. If you look over history, you probably would see 23, 25 times on average of US large cap growth multiples. So this is much higher than that. And growth stocks deserve a premium. It depending on how much confidence you have that they're going to grow faster than stocks on average in the market. But it's a degree. It's how much you're willing to spend, and we definitely saw elevated valuations at the year. And the disparity between the growth valuations is also something that has been an outlier. As you can see, the US large cap value multiple for 2020 was 20.6 times. So the difference between the growth and value valuation measures were quite outsized before we even started the year. Now, at the end of the year, we show the same multiples there. And as you can see, growth stocks still command a premium over the value stocks. But the value stocks, the difference between the multiples actually increased over 2021. And if you think about it, I just on the previous chart showed you that value in many of the segments that we looked at outperformed growth over the last year, but their valuations actually became cheaper. So that's when you get to the final percent change column, and you can see that the value column, all the numbers have compressed more than the growth column. So this means that the earnings for the value companies have actually been growing quicker proportionally to the price increases than for the growth segments. So there's definitely a valuation argument that even if value has outperformed the last year, they're still trading at a very cheap multiple. And another dynamic that might actually be driving some investor favoritism that we've seen going into value in 2021 is the expectation of interest rates going up. And interest rates are a discount mechanism that investors use to discount earnings. So all else equal, if a company is expected to have a lot of earnings in the distant future, compared to another company that has near-term earnings that are very visible, and you don't have to wait 5 years to realize, all else equal, you discount that to present value using a treasury yield, the near-term earnings are going to be worth more. So that is a factor going into the valuation of the stock market, and possibly a catalyst for why 2021 was such a unique period for value, given it hasn't outpaced growth for some time now. So where do we go from here? The outlook, now I'm not an expert on COVID and all of its variants, but there appears to be a lot of news out there that this variant may actually be a blessing in disguise. The blessing being that it does not appear at the moment to be as severe and fatal as previous COVID variants, but it also is very infectious. So this is expected to really affect a lot of people, and them getting the Omicron variant, and hopefully not people not getting severely ill and having fatalities, which will ultimately give everybody the antibodies and create herd immunity. Across our investment teams, there's a lot of discussion about this, and it tends to make a lot of intuitive sense. And so, if Omicron ends up to be turning the pandemic into an endemic, what does that mean? Well, it probably means less need for monetary stimulus, which would be rising interest rates, which we've already seen. It probably means that people are going to be, given how cheap value stocks are, investors are going to appreciate companies with current and near-term earnings as the consumer normalizes their activities and goes back to the way that they consumed pre-pandemic. So think about going on vacation and cruise ships and going out to restaurants. All of those areas really suffered during COVID, and they are trading very cheap. And this could be the catalyst for investors starting to favor value. And then the discount mechanism that I mentioned, if the higher interest rates go up, the more current near-term earnings are going to be valued and desired by investors. And this actually exists across non-US stocks as well, as I've shown in the previous slide. This is not just a phenomenon in the US. So those are some outlook, some investment themes that we have. The risks to these themes are probably pretty obvious. We could get another COVID variant. We do have labor shortages. The rise in inflation and with rates could be, depending on how high they go, could be troubling for some companies to absorb. So to mitigate those possible risks, we feel that investing in companies with strong balance sheets that can weather those storms, and call that low, carry low levels of debt, have strong free cash flow. If we have one of those risks emerge in the next year, you would hope that those companies could weather those storms. So what does a investor do at this point? And this is quite simple, and I think simple is good. As I started out my comments, the growth area of the market has been outperforming for many years, and has become a very large portion of people's equity allocations, just as a result of them growing in size from price appreciation. And if you even look at the indices, the market, passive funds, S&P 500, there is a very high degree of concentration in some of the largest names that I've said before. So it's our observation that there's a lot of investors that are probably overweight those segments of the market and should aim to rebalance at this point and rebalance into cheaper areas of the market that appear to be regaining investor favoritism at the moment. You know, this also relates to U.S. equities outperforming non-U.S. equities for some time, and the non-U.S. equity exposure should probably be reviewed and balanced with investors' U.S. equity exposures as well. So with that, I'll hand it to my colleague, Jim Jackson, to give us a fixed income review.
Thank you, Kelly. I would like to start by looking at our key takeaways in the fixed income market from the fourth quarter. First, we saw positive quarterly returns across the major fixed income indexes. Second, spread performance was mixed and the Treasury curve flattened, driving performance. Third, the consumer price index remains elevated, well above the Fed's long-run target. And fourth, we do think that even though credit spreads are still relatively tight, that this is a positive environment for credit in 2022. Now, to take a more in-depth look at performance for the year, in the fourth quarter, we saw positive performance primarily driven by the flattening of the yield curve and some modest improvements in credit spreads. As a reminder, credit spreads are the additional compensation investors require to hold securities that aren't as safe and liquid as those issued by the U.S. Treasury. The very long end of the Treasury curve fell during the quarter, contributing to the modest increase in the corporate and Treasury index, as yields are inversely related to price. Annual returns in 2021 were broadly negative on higher Treasury rates, with two exceptions. U.S. corporate high yield had strong performance as credit spreads tightened more than yields increased. The same dynamic also benefited muni bonds. Now, looking at the relative relationships amongst various fixed income metrics, during the fourth quarter, we saw investment grade spreads widened, although only slightly and off very tight levels. Corporate credit spreads, both investment grade and high yield, widened on the emergence of Omicron in the middle part of the quarter, but recovered strongly into year end, particularly for high yield. We will cover more on this later. The differential between credit ratings remains compressed. Credit ratings are split broadly between investment grade and high yield, where AAA is the highest investment grade rating and BBB minus the lowest. BB is the highest high yield rating. The compression between different ratings is represented by the difference between BBB rated bonds and single A rated bonds on the lower left-hand chart, and BB rated bonds and BBB rated bonds in the middle chart. The Treasury curve also continued to flatten, as evidenced by the difference in yield between the 10 and 2-year Treasury bonds, as represented on the lower right-hand chart. Now, to do a deeper dive into corporate credit spreads, we saw them march higher in the middle of the quarter, as you can see on the far right-hand side of this chart. However, once we reached the latter end of the quarter, credit spreads started to tighten into year end, with high yield ending the quarter 4 bips tighter and investment grade spreads 8 basis points wider. Throughout the entirety of 2021, credit spreads were lower for both high yield and investment grade. As a reminder, again, credit spreads are the additional compensation over similar duration Treasury securities for taking credit risk. Looking at the yield curve, the Treasury curve was one of the dominant factors driving fixed income returns this year. This chart shows the U.S. Treasury curve which is the graphical representation of the yield on U.S. Treasury bonds at various points along the curve. During the fourth quarter, the Treasury curve flattened, which means that the slope of the curve declined, indicating that the yield differential at each data point was lower. This was a trend that we saw for the first 9 months of the year as well. The flattening of the curve in the fourth quarter was driven by a large increase in rates on the short end of the curve with maturities of 5 years or less. This is an indication of the market anticipating the Federal Reserve tightening monetary policy in 2022. Long rates fell during the quarter after rising for the first 3 quarters of 2021. Next, I'd like to talk about one of the most talked about topics in 2021, and that is inflation. After the consumer price index started increasing in the second quarter of 2021, it was fairly stable during the third quarter, although at a higher level than we have seen in recent history. This was short-lived, as during the fourth quarter, partly due on higher energy prices, inflation started to rise again. This more persistent inflation is cited by the Fed as one reason it is expected to tighten monetary policy in 2022. Next, I'd like to outline our outlook for 2022. It has 4 themes. First, we expect excess positive returns for investors in credit, even though credit spreads or the incremental yield offered to investors to take credit risk are still relatively tight to their levels throughout history. Excess returns are returns relative to similar duration Treasury bonds. Second, we think active credit selection will be key to performance. Third, within credit, we are currently biased towards asset-backed securities or ABS over corporate bonds on the short end of the Treasury curve and higher quality bonds over lower quality bonds within investment grade credit. And fourth, we think investors should focus on fundamental credit to drive risk-adjusted returns in 2022. So far, we have discussed the current interest rate environment and inflation and how these topics have dominated the market in 2021. It stands to reason that investors might want to reposition based on an expectation that, for example, rates will rise. We would caution against it. Our answer to the question of what fixed income investors should do is consistent across various market and environments. Stay invested in fixed income, using it to generate income. Don't try to time interest rate changes and rely on fixed income's role as a time-tested portfolio diversifier. The next few slides will provide the rationale behind our approach. This chart shows how the level of starting yield or income drives subsequent returns. When an investor targets a specific level of interest rate risk, then the yield or income drives in excess of 90% of the returns over the 25-year time period that we looked at. When you start to think about the risk that you're taking within fixed income, one of the key components is interest rate risk. We think that investors should match their interest rate risk profile of their fixed income portfolios to their risk tolerance. Duration, which is a measure of interest rate sensitivity, is our preferred way of looking at this. In short, the longer duration, the more sensitive your bond portfolio is to interest rate risk. Historically, this trade-off is that longer duration bonds have higher yields. So, for example, if a bond has a duration of 5, then a 1% increase or decrease in interest rates would increase or decrease the portfolio value by 5%. Now let's see how this change in rates impacts returns over time using our hypothetical bond portfolio with a duration of 5. The table in the lower left-hand corner represents the scenario where rates rise 1% in the first year and are stable thereafter. So rates rise 1%, the value of the bonds falls 5%, but the yield increases by the same 1%. The result is a weaker return in the first year, but stronger returns in subsequent years due to the higher yield. The table on the right-hand side represents what happens when yields decline. The price of the bond increases 5%, yet the yield goes down 1%. The end result is that over a 5-year time period, the cumulative returns are almost identical. The conclusion? Making these changes on the expectations of rate changes is likely an overreaction. We would also posit that making the correct call on whether rates go up or down is unlikely. First, you have to make the correct call twice, when rates are going to rise and when they're going to fall. Second, our observations have shown that neither the market or forecasters can accurately predict where rates are going to go. The left-hand chart shows the Treasury yield curve. The green line is at the end of 2021. And the blue line is a Treasury curve constructed using 1-year futures rates at the end of 2020. As you can see, the futures market could not predict where rates were going to be at the end of 2020. The chart on the right shows the Wall Street Journal survey of professional forecasters and their prediction of the 10-year Treasury rate at the end of 2021 over the first 6 months of the year. As you can see, from the black line being the actual Treasury rate and the straight lines being the rates predicted by the forecasters, is that almost every single forecast was wrong. So the conclusion is that the market, through market pricing, can't predict where rates are going to go, and professional forecasters can't predict where rates are going to go. I would posit that the chances of any individual doing so are unlikely. The other aspect to consider is the opportunity cost of being out of bonds. So let's summarize what we have covered so far. The impact of interest rate changes on bond portfolio performance over time is more muted than you would expect. Market pricing and professional forecasters have a frankly terrible track record of predicting where rates will go. We would add that the opportunity cost of going to cash in an increasing, on the anticipation of an increase in rates is fairly high. The lower straight line represents the return to cash given yields. The remaining lines represent the return on bond portfolios if rates are stable, which is the green line, if rates fall by 1%, which is the blue line, or if rates decline by 1%, which is the black line. There is a small advantage to going to cash in year one only if rates rise. But, and this is a big but, to realize this advantage, you would have to correctly predict that rates are increasing, which we have shown to be very, very difficult. And you would have to predict when to exit cash and buy bonds, which we would posit is just as difficult to do. This very specific scenario where you would benefit, and we would argue that that successfully executing this very specific trade is unlikely. The last point that we would like to make is that bonds should not be considered in isolation, but as part of a diverse investment portfolio. Here, the benefit is clear. Bonds are lowly correlated with stocks, providing strong, time-tested diversification benefits. In short, over time, as stocks go down, bonds tend to rise, providing a ballast to your portfolio. So in conclusion, we focus on a consistent approach to fixed income. We focus on generating income. We focus on ensuring our duration exposure matches the interest rate profile that is embedded in each product. We do not invest based on making a correct call as far as the movement of interest rates. And we firmly believe that investing in fixed income as an asset class is a key part of every investor's portfolio. Thank you so much for your time.
Kelly, thank you. Jim, thank you both so very much for your time this afternoon. Do have a couple questions that we have gotten from the audience that just want to bring to both of you. So first, a question for both of you. is, we've talked about interest rates going up. We've talked about potential market shifts due to inflation. Are there any specific types of investments or asset classes that clients should investigate, or that may benefit in conditions like that? So for both of you, so Kelly, if you could start with that and then pass that to Jim.
Yeah, so inflation is more challenging for some industries and sectors than others. And a big element of that is, are the companies able to pass on the cost of the higher input costs of their goods and services to consumers, and can consumers afford to sustain their demand for those goods? And so as it relates to the equity markets, I would suggest that, cheaper valuations is a much better risk managed approach for investing in companies that are going to face these potential challenges. And then I also would suggest that identifying industries and sectors where the goods and services they provide are more of a necessity for consumers versus ones that are more of a luxury. So if a consumer needs to cut back on their spending, presumably they would cut back on things that are of non-necessity and try to retain the consumption of things that are of more necessity. So that's the way I would approach that. And there are various elements that you can identify how the return is generated by a particular stock. One is companies typically establish dividend policies that they do not want to have to cut. So company managements usually institute dividend policies that they think they can maintain in good, indifferent, or bad environments. And so to the extent that a dividend provides an investor with sort of a floor of what they can expect from the return results of investing in a stock, that should probably be a strong consideration as well. Jim?
Sure. I think I would make two points. One, we think the best way for an investor to protect against inflation is to maintain a well-diversified portfolio and to stick with their strategy through time. And diverse portfolios tend to beat inflation over time. And I would simply start with that sort of overarching comment. Within fixed income, we take an active approach to managing fixed income. And one of the things we do is we take exposure to credit risk, through things like corporate bonds. And historically, when inflation is high, interest rates also rise to some extent, and credit spreads historically are inversely correlated to treasury rates. So when treasury rates rise, corporate credit spreads decline, and that provides a ballast to that rate increase. It also provides a higher level of income, which, as we've shown here, can offset some of the price declines from a rate increase. And that is basically what we saw in 2021, where treasury rates sort of broadly increased throughout the year. And year over year, we saw credit spreads fall for both investment grade and high yield.
Thank you both. I appreciate that answer. Quick question that I would like to address is, we had a question that said, should retirees with investments who have adequate monthly income continue to invest for growth? And a question like that actually generates an answer of, it depends. It depends on what the goal for this investment is, and it also depends on several risk factors. One of the important risks to consider is someone that has recently retired, we'll call them 65 years old. There's a very good chance that their life expectancy is going to take them well into their 90s. So as much as retirement is a great event, that still could be potentially another 30-year investment window with which to grow and to generate wealth for. And so a concern and a risk to consider is longevity risk, which is the risk of outliving your assets, which is certainly not something that we're doing everything we can to address. Kind of a similar question for you, Kelly, is the question came in, is portfolio allocations for someone who is retired. Should we see growing value in older brick and mortar companies versus some of the new technology companies? And they mentioned FANG as an example.
Yeah, and kind of leaning back on some of my earlier comments in the presentation, these FANG stocks are obviously great businesses, and they are definitely here to stay. But I do think that if history is any lesson, investors do not have an endless appetite for richly priced stocks. And as I showed in my earlier slides, the disparity between the valuations of growth stocks and value stocks are quite significant at the moment. And so it seemed prudent and better risk management to be more balanced across growth and value, despite the very strong business models that the big FANG stocks have. They are priced for perfection, and there are a lot of stocks out there that are priced really cheaply. So I would just broadly suggest a more balanced, diversified approach.
Great. Thank you, Kelly, for that. One last question for Jim is, you've talked a lot about interest rates increasing and the role that fixed income and bond investments still play in a diversified portfolio. Specifically, there's been concern that as the market value of the bond decreases as interest rates go up. Can you spend a moment to go a little bit further into why the total return is really, I think, the metric that you've been describing, that you're looking at as really the most important metric as a role in a fixed income portfolio, as opposed to just looking at the valuation of the bond, or in this case, a bond fund as a whole?
Sure. Thank you. I would start with saying that the bond returns in the short term have two components. One, it's price changes in the bonds that are driven by the daily changes in interest rates, and depending on what types of bond, whether it's just the treasury rates or treasury rates plus some sort of credit spread added to it, that will drive the day-to-day returns. The other component of returns is the income generated from those bonds. Now, over time and over the life of any particular bond, the primary driver of performance, the great majority, in excess of 90%, is driven by the level of income generated from that bond. So even though you may see some day-to-day price changes based on rates moving, the starting yield at which you purchase a bond or a portfolio of bonds is what will drive returns over time. So that is consistent. We have seen that over rolling 5 or 6 year periods, looking at it over a span of 25 years. And we think that is important to note when there is an expectation that rates will increase. And a lot of that expectation, if not all of it, is embedded in the changes that we've already seen in the yield curve, that certainly generates a lot of concern that the price of bonds will fall. But the offset is that those bonds that you're holding will generate a higher yield, and over time, that is what is going to generate the returns of your holdings.
Jim, thank you very much. Kelly, thank you very much. I appreciate all of the insight that you shared with us. This does conclude our virtual event. Thank you for attending. If you have any questions, please feel free to reach out to your wealth advisor at 1-800-235-8396. You can always visit us online as well at our website, vcm.com, as well as on Facebook and Instagram. Thank you once again. We appreciate all your time so very much, and I hope everyone has a great rest of your day.